Now, often investors focus more on the statistical aspect of investing, but that doesn't mean that behavioral finance and behavioral biases don't play a role in how markets move. And so behavioral finance is an area of economics that studies how psychology affects financial decision-making, challenging this idea, right, that is inherent in most models of markets, of pricing, that people act consistently rationally. Now, the whole basis of this is that there are certain biases that affect all of us. Loss aversion, confirmation bias, recency bias, the idea that we don't want to lose money. We are more often more worried about losing money than gaining money. The idea that we look for things that confirm what we believe, all of which can lead to poor investment decisions. Mental accounting and anchoring also can be a problem. This is the idea that how you perceive money and risk can often lead to irrational spending and investment choices. Often we talk about momentum, technical factors. Does it make economic sense that just because a company's price is doing well, that it will continue to do well? Well, you could make an argument that the driver of its return, its profitability, its growth, any of these things could be continually driving things forward. But there's also a little bit of something called herding behavior in there. People tend to want to follow the group. In this case, they want to follow stocks that have done particularly well. Maybe you work for a company. You own shares in that company. You may be subject to familiarity bias, which leads you to under-diversify. You're favoring those local or well-known or familiar names rather than looking for better, more diverse opportunities elsewhere. Now, behavioral finance contradicts the efficient market hypothesis, the idea that companies' information, or rather company stock prices, are good representations of all available information. All public available information, showing that maybe there is a little bit of mispricing here between what the fair value of a company is and what it is trading at. Now, one issue is, how do you overcome this, right? How do you realize that you have biases, that there are things that are leading you to do things that are irrational, that are against your own self-interest? Well, the first key is to understanding and identifying where these gaps exist. Try and get diversified information sources. Don't try and prejudge things based on your experience. Try to understand them through the experience of others, through others' educational experience. Understanding behavioral finance can help you move beyond the traditional lens through which people tend to identify investments within markets. Because behavioral finance is the study of real psychological biases that affect each and every one of us.